Diversification is protection against ignorance. It makes little sense if you know what you're doing. So says Warren Buffett. At first glance, this comment might seem disparaging, but I believe it's positive. Let's face it, let's admit it. Your average beginner investor does not understand what they are doing. Therefore, in my opinion, they need to diversify their investments. When we return, we'll look at ETFs, mutual funds and index funds as a means of diversifying your portfolio. Hello everyone, my name is JP of JP Financial and Accounting, Everyday Finance Made Simple. On this channel, we try to train, to coach and to equip you with relevant money management skills. And of course, we always try to glean as much wisdom as possible from scripture. This is a two-part video series. In my last video, I looked at what beginner investors need to know, what they need to think about. I looked in particular at risk. If you have not seen that video, I'll link it below, and I think you can click it somewhere here if you want to go and check out that video first. But in summary, it looks at the risk of investing in the stock market. In this second part, we're going to look at diversification, what it means, and how we can diversify our investment portfolios, particularly looking at the stock market. Therefore, we are going to discuss mutual funds, we are going to discuss index funds, and ETFs. Question: what is diversification? The book definition of diversification is a risk management strategy that mixes a variety of investments within a portfolio to lower the risk of any individual holding. I know that if you are a beginner and you have not been to business school, that might seem meaningless. Let's try and explain. Diversification is a cautious approach to investing. You look at yourself as an individual and say, I do not know a lot about how these shares are going to perform or how these investment assets are going to perform in future. Because I do not know a lot, therefore I am not going to put all my eggs in one basket. Instead, I will put them in different baskets. Just in case one basket drops and the eggs break, I am protected because I have other baskets that are still safe. In our last video, we looked at different investment assets. We spoke of real estate investments. We spoke of investing in cryptocurrencies, for example. We spoke of investing in commodities. So when you are diversifying your investment, you are saying, I am not going to put all my investments in equities. I'm going to put a bit in commodities. I'll put some in equities and so forth and so on. Even when you're investing in equities, you can still diversify by saying, I am not going to put all my eggs in the same stock, but I want to put them in different stocks. For instance, let's say you have £100 to invest. You decide, I'm going to buy £40 worth of Apple stocks. I'm going to buy £30 worth of Amazon stocks. I'm going to buy £30 worth of Microsoft stocks. So that way you have spread your risk over the three companies. Why then does Warren Buffett say it makes little sense if you know what you are doing? Warren Buffett is right, because if you know how each individual company performs, you will be able to differentiate between those companies that are going to do well in the stock market and those that are not going to do well. And therefore, if you know which ones are going to do well, then you might as well put all your money in that company that will do well. But since the average investor does not know which companies are going to be able to do well, therefore, the average investor is well advised to put his investment in many different companies, so that in case one fails, they are cushioned against that loss by another company that does well. If only we had a crystal ball, then we'll look into that crystal ball and we'll be able to tell which companies are likely to do well and put all our eggs in that company. In fact, according to the online encyclopedia, Investopedia, studies and mathematical models have shown that maintaining a well-diversified portfolio of 25 to 30 stocks yields the most cost-effective level of risk reduction. This nicely brings us to mutual funds, index funds, and ETFs. What are they? How can we use these to diversify our investment portfolio? Without these funds, it would be a nightmare for an average investor to invest in many different companies and diversify. We have already spoken about investing in at least 25 to 30 shares. Without these kind of funds, it would mean you would go into the stock market and buy the required number of Apple shares. You go back to the market and buy the required number of BP shares, Tesco shares. If you are to do that 30 times over, you can see that that will be a nightmare for the average investor. Maybe it could make sense for companies that employ people full-time to do this kind of work. But for the average investor, that will take a lot of effort. So thanks to index funds, thanks to mutual funds, we do not need to do this. The question then is, what are mutual funds? The book definition of mutual funds is, mutual funds are investment strategies that allow you to pool your money together with other investors to purchase a collection of stocks, bonds, and other securities that might be difficult to recreate on your own. Typically, mutual funds are managed by professional managers, and therefore when you invest in a mutual fund, you expect to pay that manager for his work. Whether he makes money or he doesn't, you are still required to pay him. This can prove very expensive to the average investor because at the end of the day, you could discover that you are paying a significant chunk of your returns to that professional investment manager. If I may add before I forget that the term mutual fund is generally an American term. In the UK, we tend to use the term OICs or open-ended investment companies to refer to mutual funds. Moving on, what is an index fund? An index fund is a mutual fund designed to follow a certain preset rules so that the fund can track a specific basket of underlying investments. Again, that's difficult to understand that for the average investor. Simply put, an index fund is a mutual fund that is not managed by a professional manager. Instead, it just tracks an index. We'll look at what an index is shortly. What about an ETF? An ETF is very, very similar to an index fund. The difference is the way they are traded on the stock market. ETFs can be bought or sold at any time, whereas index funds are only priced at the end of the trading day. Swiftly moving on, let us explain what an index is. An index is a method to track the performance of some group of assets in a standardized way. Indexes typically measure the performance of a basket of securities intended to replicate a certain area of the market. I know that this does not mean much to an average investor, but what does it mean in layman's terms? An index is like a basket of shares of companies. In this basket, shares can be organized in different ways, depending on who is putting those shares in that basket. For instance, they can be organized by country in which the companies are based. In other instances, they can be organized by industry. For example, it could be mining shares in that index. They could be organized by technology. For example, you could have an index fund with all the big tech companies. I think the most commonly known index funds are the S&P 500 and the FTSE 100. What are these? Let me briefly explain. The S&P 500 is a group of the 500 largest corporations in America. This is what you see on your screen right now. You will see some familiar names. For example, 3M, Adobe, Google, Amazon, American Airlines. So it's a long list of 500 companies. So the S&P 500 index fund tracks the performance of these 500 companies. And as you can see there, it shows how they are performing from day to day. Another well-known index fund is the FTSE 100. This one is a UK-based. Again, it is the top performing companies in the UK that have been organized by the FTSE. FTSE stands for Financial Times Stock Exchange. So the top 100 performing companies are grouped in here also. And again, here you will see some familiar names, e.g. Anglo-American in the metals and mining sector. You will see Aviva PLC insurers, BAE Systems, Barclays, the big banking corporation. So the top performing UK companies are grouped here in the FTSE 100 index fund. So when you buy an index fund, it is like you are purchasing a small portion, a tiny portion of these companies. And the index fund tracks the performance of these companies. So when one company does well, you get a good return. But inevitably, the companies won't perform exactly the same. Some companies will do very well, while others will not do as well. But your investment continues to grow because, in general, that fund is growing. As we said in the previous video, the stock market in the short term, on a day-to-day, it's volatile. There are ups, there are downs. But in the long term, it just tends to grow. For instance, the S&P 500 fund that we looked at earlier on, over the long period of time, it is projected that it will give returns of between 6 and 12%. So your investment will grow between 6 and 12% in the long term, in spite of the ups and downs. So in the long term, you can expect your investment to grow. For your homework this week, I'll say go and research how you can open an investment account. I'm quite familiar with how Vanguard works, but I'm not so familiar with how others work. But you can look also at Trading 212. You can also look at Hargreaves Lansdowne. Finally, let us look at our verse of the day. Our verse of the day today comes from Ecclesiastes chapter 11 and verse 2. And it reads, "Invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land." So what the wise man is telling us here is that we need to diversify our investments. As we said earlier on, do not put your eggs in one basket. If your investments are diversified, if one fails, the other may bring a good return. Whereas when your eggs are all in one basket, you risk that you could lose everything. Remember in the previous video when we spoke about risk, we noted that it is possible to lose a significant chunk of your investment in the stock market. And it is also possible to lose everything, absolutely everything. If you put all your investment in one company, for example, and that company fails, you lose absolutely everything. So the counsel that we get from the Bible here today is we must invest in at least seven different ventures. So even when you are investing in these different index funds, you can consider looking at different indexes, for example, to ensure that in the long term, it is unlikely that you will lose any of your money while investing. I hope you've enjoyed this video, and I hope it will help you on your journey to investing as you learn how to invest and what assets you can choose to invest in. If you have enjoyed this video, please like the video, and if you're not already a subscriber on this channel, please click the like button and that notification bell. It will help me to reach a larger audience. Bye for now. God bless.